chapters. And today's chapters are very intricate, and they are also examinable in the current syllabus. So we're looking briefly at chapter 9, and that has to do with evaluation and review. So by way of units, the module chapter 9 has about 4 units, principally looking at the review stage of the audit. The review stage of the audit is after you're done, you're doing your final reviews. Then we're looking at opening balances and prior comparatives based on international standards on auditing 510 and 710. Then we look at unit 3, which is subsequent events, events after reporting date, after you've done the audit, what transpires, what comes up. And also ISA 570, looking at going concern of the business. Is the business working or from the financials looking to operate in perpetuity or in the near future? And these 4 chapters, or these 4 units, rounds up chapter 9, which is evaluation review. We look at our quiz after it. So by way of unit 1, let's look at the review stage of the audit. So there is need for review, and this review entails broader check after detailed testing. So after we've done our detailed testing, substantive testing, test of details, sampling.
Okay, everybody.
Yes, please. Yes, please. I'm recording already.
Okay.
Yep. So after we've done analytical procedures as our first sense check of the draft financial statements, there is need for review. So this review is very important because it helps us understand the analytical procedures and help us verify the accuracy and ensure that all significant items are properly or appropriately reflected. So it's very important that there is a need for review, and this review are very essential to ensure due diligence have been done to the financial statements audit. So the objective essentially for evaluation of material misstatements based on ISA 450 is to evaluate the effect of identified and uncorrected misstatements. So what is a misstatement? Is an incorrect amount, maybe significant in size and volume. So we look at the size, incorrect amount of that size and the amount, and a misclassification, misrepresentation, or a disclosure that was in the wrong place based on the postings of the process owners. So a misstatement is very important, and that is why the review stage of the audit is carried out to ensure that these misstatements are not off our eyes as auditors. So we need to take note of them and ensure that the procedures, which includes we accumulate all non-trivial misstatements, no matter how immaterial they are, we need to accumulate them, document them, and put them in proper context, calling management's attention to them. So every procedures, whether trivial or non-trivial, material, immaterial, we need to accumulate and document any of these findings based on their materiality. And if total approaches of materiality, our revised strategy or audit plan issues during the audit, we need to communicate all the misstatements to management and also request their correction. So we need to correct it. We need to communicate to management for their correction. We flagged it, and we'll make sure that during this review stage, okay, we found this, we found this, we found this. Management, you need to correct them appropriately. So if management refuses, we need to obtain reasons via dialogue. And that's why communication is very important, especially documented communication with their reasons. And we should also understand and consider the impact of the material misstatement and the free conclusion. So if management refuses to make the adjustments or whatever it is we are flagging, how will it impact the financial statement is very important. So the materiality of those amounts, the immaterial ones, and their reasons, if communicated to us, for not going to carry out or go ahead with our recommendation, we should capture them documented. We should document all those very, very important correspondence with management. We should also reassess materiality based on ISA 350 before evaluating incorrect misstatements. So in reassessing materiality, we need to be sure that these materiality thresholds are actually very, very material. And every uncorrected statement should also be substantiated via our reviews. So we need to decide if uncorrected misstatements are material. So if the management refuses to correct the misstatement, we need to decipher if it's individually or aggregately misstated. Will it impact the financial statements significantly? We need to also consider the size, the nature, and the circumstance and the prior period of these uncorrected misstatements to evaluate their impact on the financial statements. These reviews are very important. We also need to communicate the potential impact of uncorrected statements or misstatements on the financial statements. Very important. So we need to understand that these misstatements, if they will influence the decision of stakeholders and shareholders, we need to communicate to management the importance of correcting them and also obtain written representation. So whatever correspondence we have should not be verbal, it should be written. And that's why we have the management letter, representation letter from management on immateriality of uncorrected statements or otherwise the materiality of these uncorrected statements in writing. Very important to take note of that. And documents, we need to document everything. Like I used to say, if it's not documented, it is not done. So trivial amounts, thresholds, all accumulated misstatements, the ones they corrected, uncorrected, conclusions on materiality of the uncorrected statements, everything must be documented so you have your appropriate audit evidence, appropriate sufficient audit evidence that will make you or propel your report to be written. This is very, very important. So other areas of evaluation and review includes opening balances like beginning inventory to the end. You look at the movements during the year to substantiate and validate that these comparatives and everything that has transpired over the years have gone and they are mathematically accurate. We also need to ensure that other information with the financials, subsequent events after reporting date, the going concern status of the entity is also reviewed and evaluated. Very important. So the review stage of the audit is of paramount importance, and we need to ensure that this stage is properly evaluated and due care is provided and ensured to make sure the job we do is seamless and value adding. Very important. Okay, so we'll just run through the review stage of the audit, and that will be the end of unit 1 of module 9, chapter 9, which is evaluation and review. Do we have any questions on this? Welcome. I can see Rufiat on the call. Rufiat, nice to have you. I'm having a good time with Julie here. You're welcome. How was your day?
Yeah, it's good evening.
Rufiat, you're muted.
She's not out.
Yeah, she's muted.
Good evening. Maybe she's far from her
phone,
system.
Yes, her system, exactly. Okay, so she'll come along and we'll continue. So let's look at unit 2, opening balances and prior period comparatives, ISA 510 and ISA 710. Let's look briefly at this. So opening balances and comparatives involve accounts, ledgers, transaction postings, and mostly these financial include prior year comparatives. So what you're comparing last year to this year. Yes, please. Yes, please.
Which one is the opening balance? Is it 510 or 710?
Oh, okay. Opening balances is 510, then prior period comparatives is 710. Did you catch that?
Opening balance is 510, then?
Yes, and prior period comparatives is 710.
Okay.
Yes. Okay, so opening balances and comparatives. We're looking at most financials that have prior year comparatives. So you have 2020, you have 2021, so you are comparing them. And most of the audits and your financial statement audits are not just 1 year, they are 2 years. So you do 2020, 2021, then you compare 2022, 2023, and you compare 2023, 2024, and it goes like that. So we need to be confident and have this level of comfort that the opening balances agree with the prior year audited figures. So for example, the closing balance of the inventory for last year should be the opening balance of inventory for this year. So we need to make sure these comparatives are in agreement. Very, very important. And whatever adjustments have been made subsequent to after the financial reporting date, the auditors need to be aware and duly communicated to on such adjustments. So accounting policies consistently applied as part of the comparatives, and this consistent classification and disclosure are very essential. The initial audits, opening balances we spoke about for a particular year entering into another year, we have to be guided when prior financial years financial statements are not audited or audited by a predecessor, an outgoing auditor and an incoming auditor is coming to review what has been done previously. We need to be very sure that whatever it is we are carrying over are correct and they align, they marry together. It's very important that there are no dichotomies in this figure. And what's the objective is to obtain sufficient appropriate evidence. I'm sure you're already used to these terms, this very important phrase in audit by now.
It's a 500.
Yeah, no. This phrase of obtain sufficient and appropriate evidence. That phrase is very important.
That's why I say 500 now.
Yes, I say 500 exactly. That the opening balances don't materially misstate the current financial statement. So the objective of this is to ensure that appropriate policies are consistently applied across the board. This is very important. And what are the procedures? We need to read prior appropriate evidence. Exactly. So the procedure is to read prior financial statements or reports, check carried forward balances. We need to check policy appropriateness. We need to review working papers of our predecessors. And if the financial statements are audited, we need to consider the evidence from current procedures on the opening balances. So where two auditors are involved in this job, so they need to carry each other along to ensure that both of them are on the same page. So for example, cash received from opening receivables. We need to perform specific procedures on opening balances if potential material misstatements are found. So receivables as at a particular cutoff year, and immediately we come into another year, those receivables are received as cash from customers. So we need to be sure that appropriate postings are done, and where provisions are made based on IFRS 9, ECL, the expected credit loss model or provision, we need to substantiate and appropriately post, especially where it affects end of the year balances and into the new year. So we need to be sure that potential material misstatements found and also perform additional procedures and also communicate to those in charge of governance, which is clearly stipulated in ISA 450. Very important. We also need to check consistent application of policies, the depreciation policy, estimates, and disclosure and changes. We need to be sure of the appropriateness year in, year out. ISA 710, looking at comparative information, applies to every audit we carry out. So the standard is clear on every comparative information and it applies to them graphically. So we need to focus on corresponding figures and comparative financial statements. So procedures on these comparative figures between last year and this year are less extensive than the current year. So we just need to be sure that both years and both financials tally because they are presented on the face of the financial statements, 2 years pari passu. So we need to ensure that our procedures are properly catching what is essential and the procedures for this year will be reduced in effort and in performance, because last year may be rigorous due to auditors starting the job, or that's the first review. Normally, second reviews are less rigorous, and that's why it's good to do the job at first sitting very, very well. Also, we need to evaluate agreement with prior periods or restated postings, which enhances us or prompts, culminates in consistent application of policies. So in our evaluation, we need to understand that what happened last year should be correct and correctly stated. We need to ensure that there's proper treatment and changes in the financials that we are evaluating. So whatever is being done must be evaluated and reviewed properly by us, the auditors. This is key. And also we need to perform additional procedures if we are aware of potential material misstatements in the comparative analysis we are doing between last year and this year. If there are any material findings that comes to our attention, then we need to test and additionally do substantive procedures to validate and substantiate that these material misstatements are not influenced or influential on the financial statements. And during our current audits, we need to obtain written representation covering all periods in the opinion we are about to issue. It's very important. So whatever is done last year and this year, you know, say, I don't have any business with last year. If it's material and it comes to your attention, you need to validate and evaluate to ensure that the financial statements are not misstated in the prior year and the current year. This is very, very important. So the audit opinion normally doesn't refer to corresponding figures unless specific circumstances. We'll be looking later at this audit opinion in, I think, chapter 14, which is reporting. We're looking at that substantially. So the audit opinion doesn't really refer to figures. It refers to systems, processes, and if the financial statement is presented and is the true and fair view of the financial statement is clear, and the opinion of the auditors are geared towards it. So if prior financial statements are not audited, we need to also follow ISA 510, which speaks to opening balances on financial statements. So it's very important we understand that we are validating figures, ensuring the financial statements provide a true and fair view based on the year we are auditing. Okay, so that speaks to ISA 510 in brief and 710. I can see Aisha on the call. Aisha, you're welcome. Nice to have you.
Good evening, everyone.
You're welcome. Sorry. Nice to have you. Welcome.
Oh, yeah, coffee. Sorry.
Yeah, she choked a bit. You're welcome. Okay, so
My
it should be
network
fine.
is really bad, though. Okay.
Yeah, but I can hear you. I can hear you, Jay. I can hear you. It's just that it breaks once in a while, but I can hear you. Okay, so if we don't have any question on Unit 2, I believe it's a bit clear. Let's look at Unit 3, which speaks to subsequent events. ISA 560 covers subsequent events. And we're looking at events after reporting date. What has happened after we've audited the financial statements? What has happened after the opinion has been issued? And the IAS 10, International Accounting Standard, speaks to events after reporting date. And the auditing standards, ISA 560, speaks to subsequent events and what we have to do if events adjusting and non-adjusting come up. So IAS 10 is a potential in your CR reporting. So ISA 560 is also a potential in your AAA exams. So adjusting events are conditions that exist at the year end, and the financial statements shall be adjusted. Examples are issues of court cases, litigations, information on impairment of assets, final purchase costs, fraud and errors that impact the financial statement. So generally, adjusting events come at the year end, and most of the times the financial statements may have been, the opinion and the report have been issued, The audit has been completed, so we need to adjust for these events in the new year. This is very important. So that's speaking to adjusting events. We also have non-adjusting events, conditions that arose after the year end, and the financials shall not be adjusted because they've been signed off. And it's very important to understand the implication of adjusting events and non-adjusting events, and also the materiality. If they are material, we need to disclose the nature. Very important. So whether adjusting or non-adjusting, we need to understand materiality of these events and the items and how they impact the financial statements. And we need to understand that the estimated financial effect or statement of why is not estimable in notes. For example, a fall in asset value, a major acquisition or disposal, a discontinuation of a facility or a plant or a plan, major reconstruction, destruction of a plant, any substantial or significant event that happens, if material needs to be captured. Very important. So whether adjusting events or non-adjusting events, we need to be sure that the materiality is not let off our guard. This is key. And ISA 560 is speaking to adjusting and non-adjusting events after reporting date based on IAS 10. The objective is the auditor's role in ensuring sufficient appropriate evidence is obtained on these events between the financial statement date and the audit report date. So please take note of that. The objective of the auditor and his role is to ensure he obtains sufficient appropriate evidence on events between the financial statement date and the audit report date. This is very, very important. And we need...
Sorry, please, can you go back to the slide?
Statement dates.
Oh, okay.
Yeah, exactly.
Okay.
Financial statement data and what's the difference between the two?
Okay, fantastic question. So financial statement date and audit report date. We have the financial statement as at year end. Typically, we have 1st January to 31st December. And we have the audit report maybe coming between January, February, March, April, May. So between the time, let's say January to December 2024, the financial statements have been prepared, and that's the date. Now, between when the auditors are going to issue their opinion after their review, let's say January to March, there are some events that will have occurred, and they impact the 2024 financial statement. So in answering your question, the financial statement date ends 31st December, then every event that transpires between that time, and they are not events in the new year, they are also events that were as a result of transactions that were entered into, or situations like litigation and the resulting effects of what happened in 2024 financial year had come to the notice of the auditors during their reporting date. So auditors don't report as at 31st December. It's after their review had been done. So let's typically say January, February, March, maybe first quarter, they were doing that review. And these events came to their attention and it has not been captured in the financial statement. So for example, we said a situation of litigation, court case, that maybe the company will need to pay fines, penalties, and those fines may be material, and it has not been captured in the financial statement. And that speaks to events. So you need to obtain sufficient appropriate event that, okay, the court, the company was sued between January and December, but it was not decided. So maybe the auditors were doing their review between January and March, and the court decided, okay, this company will pay 2 billion as fine. You can see that event is material. The auditors need to capture it as a 2024 event. So as auditors, we need to have sufficient appropriate evidence between that financial statement date and the impact of those events and our audit report date. I believe that's a clear example of what could be that could transpire between the financial statement date and the audit report date. Is that clear? Hello, Julie. Hello, Aisha. Did you guys catch my thoughts on that?
Yeah, I did.
Oh, okay. I think Julie's network is really not I hope she caught my thoughts on what I explained. Okay, so let's move ahead.
Yeah.
I hope. Oh, okay. Oh, fantastic. Good. I could get that affirmation. So between the financial statement date and the audit report date.
My network is really bad.
Yeah, I noticed it.
Yeah,
It's
yeah.
actually nice. Yeah, understand. Okay, so we also need to respond as auditors to the facts known after the report date that might have caused an amendment. So every adjustment, amendment to the figures, audit procedures should consider significant post-end transactions, and that's what we are speaking to.
Okay.
Excuse me. Yeah, so we need to understand what happened between the financial statement date and audit report date, the audit review that is on, the financial statements have not been prepared, and also reflect that. Very, very important. Very important. You can't ignore it. There are events that occur and it's nobody's making, of course. So we need to capture that and ensure they are properly reported and the true and fair view of the financial statement is presented to shareholders. So key dates, like you guys asked, financial statement date, audit report date, date financial statement or date financials are issued. So these are key dates we need to take note of as auditors. So financial statement date 31st to 31st, this depends. There are some companies that do maybe March to February. So some will do June to June. So depending on the dates, the financial statement captures. The audit report date is very important. So between the date of financial statement and the audit report, whatever material issues or items, events transpire, we need to be sure and capture them appropriately, adjust for them also appropriately. So the dates the financial statements are also issued are very important. So what's the difference between the financial statement date and the date financials are issued? So the financial statement date and the date financials are issues are a difference between the reporting date, like we said, typically January to December, and the date those events are adjusted in the financial statement, and that's when the financial statements are issued. So when you have material events like litigation, court cases, and you reflect those adjustments in the financial statement, that is the dates the financial statement are issued. Then when the auditors reported and issued their opinion, is the date the audit report was provided or signed by the partner. So take note of these key dates. Then before the audit report, we need to actively look for significant subsequent events, and that will be after the reporting date. So look out for that. Ask what they do in practice. I noticed after the financial statements have been prepared and the auditors have finished their review, so they will ask for subsequent events and send the form to process owners. They always copy the internal audit in that mail and said the process owners should fill in that form if there are any significant subsequent date to validate that nothing has happened without their attention or their consent before they issue the final report. So after the draft report, they've sent correspondences for management to respond to issues of correction and material and immaterial issues. They will ask for subsequent events that may have occurred between the financial statement date and the audit report date. This is very important.
Sir, I'm going to draw you back a bit, please.
Please go ahead. Feel free.
I didn't get the one you said about date of financials, the date of financials. I know financial statement dates. I understand audit report dates, but the date of financials are issued.
Okay, financial statements are issued. Fantastic. So the date of the financial statement date is typically, like I said, you got it 1st to December, depending on the date adopted, beginning and ending. Now, date financial statements are issued at the date after all adjustments, recognition of events have been incorporated into the financial statement. So that's the date the financial statements are being issued. So, for example, the financial statement date and the financial statements on the values on the asset side and the liabilities or the capital side are balancing by 2 billion. But at the end of the audit, after reviews, adjustments and postings have been incorporated by auditors and agreement with the process owners, we find out that the financial statements move to about 2 to 3 billion. So that 3 billion financial statements, different from the 2 billion one, is the date the financials are issued. So that date the financial statements are issued is not the same with the financial statement date. And that's because we've incorporated new items, new findings, adjusting events, non-adjusting events have been incorporated. So the new financials is speaking to the date financials are issued. So the difference between the financial statement date and the date the financials are issued are those events that were incorporated into the financials. So like I said, like a litigation that you pay 2 billion, it was not incorporated between January to December. And the auditors came during their review, they found out the court has fined the company 2 billion. So you need to post that in your account. And when you post it, you can see it's a material event that will impact the financial statement, either positively or negatively. And please go ahead.
Can I say, like, what I understand now is that the financial statement date is like the management report.
Exactly.
While the date is been issued, the other one, financial dates, the last one,
yes,
it means audited report.
Exactly. Though the report has not been, the audit report has not been issued, but like you said, it has been audited and all factors have been factored in.
Yeah, okay.
I'm exactly. Fine. Okay, that's good to know. All right, so Julie is back. Julie, I hope you were able to sort that out. I hope so. Still can't hear how the network is still.
I'll manage with it.
Okay. Network is still.
No, I can't.
Maybe she changed location.
No, I can't even hear her. I think her voice is low though, but I can hear her.
It's the network. I have to subscribe to the Wi-Fi. I have to repay. I have to do the subscription.
No, but it's even clear now. I can hear you very clear now. It's clear.
Yeah. I just hope it does not go off again.
Okay. Let's hope so. Yeah, let's hope so too. Okay, so before the audit report, we need to actively look for subsequent or significant subsequent events, like we've spoken to litigation cases and many others. Maybe a major buy, a major acquisition, a major proposal, and anything that will significantly impact. So before the audit report is issued, we need to look out for significant subsequent events so that we can factor them in. And also after we've issued the audit report, and we're about to issue our opinion, we need to consider the impact of those significant events coming to our attention. So no active search is really required. You can just provide a questionnaire or a survey like they do in practice. I mean, copy of most of those mails, they do a survey, they send a questionnaire to process owners, kindly include if anything has come to pass between when we finish you sent your financial statement to us for review, and when we did the review, the period between our correspondences, our draggings. So no active search, no maybe significant search if you want to audit and find out independently if there's something that has gone wrong or impacted the financial statement you are not aware. Just ask management, and I think that will be okay. And the audit work is to check for IAS 10. IAS 10 is speaking to adjusting and non-adjusting events, and to ensure that we are adequately complying with this IAS. Very important. And that's what IAS 560 is addressing. So IAS 10 is the maker, IAS 560 is the checker. If we use those terms to buttress that. So the end of the reporting period to the audit report date, we need to obtain all our evidence in writing. Very important. And we must ensure that adjusting any events needs to be disclosed, identified, and properly reported. Very important. Whether material or immaterial, we need to factor that in, adjust for them in the financial statements, and post them. This is key. So in our normal audit work, sales, invoices from revenue, cash transactions after year end can provide evidence. So all these documents can validate the evidence we have. So for example, collectability of receivables. maybe provisions have been made based on IFRS 9, like I said earlier, on the expected credit loss, and those receivables were recouped. Debtors paid them. The net realizable value of inventory is also very important, and an example of adjusting events or subsequent events. Unrecorded liabilities incurred by the company, like an example is litigation case. Dishonored checks that were now honored, and money came into the business. We need to understand and adjust for these events. So we need to perform specific procedures, whether analytical or compliance, to understand management's procedures. We need to inquire, ask management, read latest subsequent financial statements that are in that same industry, look at the minutes of meetings of the board and several internal correspondences to obtain written representation. So what are we speaking to? We are saying that whatever subsequent event it is that transpired, we need to have evidence, sufficient, appropriate evidence. Don't forget this term, please. If you come across a question around this area, please write those statements. They validate what you are saying in auditing very categorically. So the date of the audit report to the date of the financial statements, we've spoken to that. If you are aware of a fact that might have amended the report, you need to discuss with management and tell them, okay, this event, we need to adjust for it, and determine if their financials need amendment. Also inquire about management's plan to amend it appropriately. So if they've amended it, perform procedures on the amendment to test and extend your subsequent event review to a new report date. So if the reporting date has amendments that needs to be factored in, you need to fast track or fast forward the reporting date. And the possible restriction of the review is to amend only with emphasis other than matter paragraph in some jurisdictions. So in the subsequent chapters, we'll be looking at matter paragraphs very importantly, and laboratory. Matter paragraphs are very important. They come out in the mostly in the questions, so we need to look at that. Also in this ISA 560, if not amended, the auditor disagrees with the amendment, a report should not be given yet. So you need to modify your opinion. So when it comes to reporting, we look at the opinion to issue if there's a disagreement between the auditor and management. And if the report is given, we need to we are instructed not to we are recommended not to amend if the issue has taken action to prevent reliance. So where there is a litigation case, we need to get legal advice depending on the materiality of the event. So wherever there's a tug of war between auditors and management, seek legal advice so that you can have appropriate safeguards, and the auditor will not be liable in case he issues an opinion and something backfires later. So the essence is to ensure that proper professional due care is enhanced during the work. You need to be careful in providing an opinion when you know an issue may impact the financial statement and it has not been appended by management. So after the financial statements have been issued, looking at those adjusting events, no obligation for procedures or inquiries is necessary. So if you are aware of the fact that there might be an amendment in the report, discuss freely with management, determine the amendment needed, and inquire about their plan to execute it. And also, if the amendment is going to be done by management, perform procedures on the amendment, extend your review to maybe substantial review, review the steps to inform the users of the financial statements, management, the board, and other stakeholders of a new report with the emphasis on other matter paragraph I will be speaking to later, referring to a note explaining, okay, we are reissuing these financial statements with a new reporting date because of these particular amendments, and the explanation to the major stakeholders and the players or the users of the financial statement is key. This is very important. So for example, a major receivable of 3 billion and inventory of 1 billion that may impact customers entering receivership after year end. The auditor's action before report issuance is very important. So you need to take note on the post report event. The auditor's action is if the event occurs after the report, but before issuance, he needs to amend the report, redate it, and also consider communicating with shareholders if the amendment will affect their decision or if there is no amendment. So take note of this example. In major material receivable, major material inventory, or any other issue that comes, but consider the materiality. A minor issue should not make you adjust or call for amendment of the financial statements after it has been issued and an audit report has been issued. So the materiality is very important, so you don't disrupt the report that has been issued over a trivial matter. This is very important. So that's speaking to subsequent event, and the examiner, I think, tests this area very well. So please take note of this ISA 560 subsequent event. So let's run through the last module. Sorry, the last unit. I think we have 5 minutes more to 9. Any question back? Do we have any question on subsequent events so that we can run through going concern ISA 570? Any question?
No.
Okay, fantastic. I enjoyed your engagement. Both of you really asked on this subsequent event. And I believe our mock exams, don't forget, we have plenty past questions to look at. After the 2 mock exams, we still have like 7 practice questions, and most of them are 7-7. So we'll see the subsequent events very well and how to address it in practice. So get ready to practice. So 28 days to go. Okay, so let's go. Unit 4, going concern, ISA 570. The going concern assumption is that a company is supposed to operate in perpetuity, shouldn't stop in near future. That's what the going concern speaks to. The company shouldn't stop as a result of liquidation or shutdown, total shutdown of operations as a result of 1 or 2 issues bedeviling it. So the financial statements are prepared based on this assumption that continued operation is in existence for the foreseeable future. So if not a going concern, current or non-current distinction, which are meaningless, like assets and net realizable value, potential additional liabilities, could be the issue confronting the company. So the auditor's duty is to be satisfied that the going concern assumption is appropriate, and he needs to investigate any financial or operational position that may affect this assumption. So the director's duties based on the preparation and presentation of financial statements based on IAS 1 should satisfy themselves of the going concern basis and its appropriateness in the financial statement. So this assumption must be stated in the financial statements presentation. So the auditor's duty is to check that these the directors have factored this in the financial statements and is well stated. So in some countries, there is a required disclosure of going concern opinion, especially towards the GAP countries, US, Canada, and others, due to the crashes of corporations there, Enron and WorldCom issues. There is, in that jurisdiction, a going concern opinion that should be issued stating the fact that this company is going to operate in the foreseeable future. So mostly for listed companies, and management is responsible for that assessment. But in the UK, the IFRS area where we gravitate towards, this opinion is not necessary. It's just stated as a disclosure in the financial statements. So the auditor's duties based on ISA 570 is to obtain sufficient appropriate evidence. So every ISA, don't forget this phrase, you need to obtain appropriate sufficient evidence, documented, not verbal, not word for word or word for mouth, and ensure that management use of going concern assumption as provided in financial statement concludes if material uncertainties on the financial statement exist. So they determine the implication for audit reports and our opinions. So we're looking at those opinions in the chapter that looks at reporting. So management needs to validate that the company, there's nothing has come to their attention that depicts a halt to operations in the near future. And that's what the going concern speaks to. So auditors need to validate that, and the objective is to ensure the company does not crash, because auditors may be liable if these procedures are not performed. This is very important. So subjective areas requiring judgments on management assumption is key. We also need to perform risk assessment procedures. We need to consider events, conditions that may cast significant doubt. So for example, losses. You are seeing net losses, operational losses, and accumulated losses in the balance sheet. These are indicators that the company is bedeviled with a lot of issues. So management may assert that, okay, we are a going concern, but these losses, you're looking at it, you need to assess the risks. What are these losses about? What is driving these losses? What are the costs? So you need to look at it appropriately and ensure that the financial statements, as they are posted, you bring this to the management's attention, and if they have a plan to remediate or mitigate those or bring down those losses, then it should be provided to you. And what is the essence is to ensure that the going concern status of the company is not in significant doubt, and also you have this level of comfort that they've told you and you've assessed that the company will continue in the near future. So if management's assessment exists, you need to discuss and determine the relevant events identified. So review management's plans that if you doubt the going concern status of the company, and if there is no management assessment, discuss the basis for the assumption that the company will continue as a going concern. Inquire about potential doubt-casting events or conditions like the losses I mentioned. Okay, what are you doing about these losses? How do you intend to get funds if your working capital management is not working? Maybe you see their current asset, current liabilities. Maybe the current liabilities are above the current asset. Those are indicators that this company is going down. You see the CA is lower than CL. I mean, it's obvious. So you need to ask, what are your plans to remediate these key indicators? These events need to be adequately addressed. And the time period is for the auditors to evaluate management's assessment period. If less than 12 months forward, they need to request assessment for at least 12 months to inquire about the events beyond this period and how they plan to address it and stay in business and stay afloat. Very important. So looking at factors that may raise going concern questions. I've stated some like losses, but let's look at what the study text is speaking to. So financial concerns, net liability, current liability maturing, current liability above net or current assets, debt without refinance prospects. So debts are increasing. There are no finance prospects to meet those debts. These are indicators or factors. Also reliance on short-term debt and long-term assets. Withdrawal from creditor support or withdrawal of a major creditor support. He stopped giving the company credit. These are major red flags. Negative operating cash flow in the cash flow statements. Adverse ratios. Instead of your cash ratio, current ratio to be above 1, we are seeing current ratio less than 50%, 25%. These are red flags. Substantial losses have stated that asset values are declining. Dividend arrears, they've not paid ordinary shareholders in a while. Discontinuance of some major plans and operations, inability to pay creditors, inability to meet long terms. So these are all indicators that the company is bedeviled by going concern issues. Change to cash on delivery, inability to finance essential development. These are all indicators and red flags we need to attend to. Also, operating factors. We've looked at financial operating factors, liquidation or cessation plans, loss of key management staff without replacement, loss of major shares or market share, loss of customers, franchise, suppliers, labor difficulties, assessing talent, supply shortages, strong competition. All these are factors, operational factors that could hamper the going concern status of the company. And ISA 570 is saying we need to assess these factors. And other factors include non-compliance with regulations, maybe not being able to pay taxes, meet external regulations, pending legal proceedings, adverse changes in law, policy belittling the company, uninsured catastrophes, insurance covers are not provided. These are all factors that could affect the going concern status of a company. Audit procedures. If you have doubt, you need to perform audit procedures to be able to come to a conclusion that this company is either a going concern or not. Very important. So also you need to obtain sufficient, appropriate material evidence of going concern uncertainty and discuss this with management, the reasons for your assumption and your conclusion, and what are their future plans, the implication of potential losses on their books, and you also obtain and review cash flow forecasts and whatever forecast and plans they have. Check and challenge these assumptions, their estimates, discuss financing plans, whatever it is with them, and review sales order books, whether there's a decline or an increase, review it. So you're essentially not doing financial statement audits now. You're looking at the going concern status based on this audit standard, ISA 570, and also review aging of receivables, longer payment times that are above 30, 45, 60 days. Consider adequacy of planned CapEx, capital expenditures. Also discuss implications of key employee departures, maybe major directors, major senior managers. Discuss implications of ongoing litigations and the possible costs that may culminate in penalties, fines, and also obtain confirmation of continued financial support from the bank externally. Get it independently, and if you can rely on that of management, but it's better to get it directly from the bank. Also obtain letter of representation from management of their going concern opinion. Very important. They should sign it that in the near future they will continue in operations. And the auditor's disagreement with management on any going concern issues, whether valid or invalid, should be documented to the auditor. So we need to discuss further with management, try to persuade management to use breakup basis to, if no agreement is considered, qualify the report. So what is breakup basis? Breakup basis is to end the going concern status of the company, or maybe liquidate or file for bankruptcy. And if they refuse, then based on the going concern issues that are very, very material and you can qualify the audit report based on that. So we look at the qualified opinion, unqualified opinion later as we go on. So we need to also communicate very, very comprehensively to management, unless all involved in management are ruthlessly showing no interest in, then we need to take it up from management to either the board or external stakeholders. So we need to communicate events first to management of our doubts, whether material uncertainties, appropriateness of the assumption, or the adequacy of their disclosures. We need to just communicate first. So they are the first level we need to communicate to before taking it to the board of directors or to the to external parties, mostly for listed companies. So significant delay in financial statement approval related to going concern, performance of additional procedures, we need to consider the impact of delay on our conclusion. So the summary of our audit work based on going concern status is our planning, assessment. We need to consider circumstances, review management's assessment and their plans. We need to seek representation and assess the material uncertainties that we have issues with. Perform detailed procedures, look at their forecasts, test them, interim accounts, loan agreements, look at their minutes that speaks to addressing the going concern issues, other levels, operational matters, and resource availability. We need to perform detailed procedures to have this level of comfort that something is being done about this. And the IASB alert, International Audit Assurance Standard Board alert, ongoing concern in 2009, highlights the importance of this to ensure that the concern we have as relates to the economic environment, macroeconomic environment impacting the company, whether credit crisis, global meltdown, economic depression. We need to understand, especially that of 2009 that came on companies heavily. We need to assess the risks and how they impact a company significantly. So the emphasis on management's responsibility and the auditor's duty, as spoken to or directed in IAS 570, the impact of credit availability of forecast and disclosure requirements need to be captured very, very importantly. So IAS 570 is a standard that addresses going concern. Our auditors need to apply graphically, practically these IASs in reaching out to an organization's going concern status. Okay, so that will be it for Unit 4. Do we have any questions on going concern? I believe when we see a question, we'll be able to address it squarely. So some of them come as sub-parts of a question, maybe the B part, the C part of question 2 or question 1 or question 3. So you'll be able to speak to it graphically. So do we have any questions? We've eaten like 10 minutes out of our break time already. Any questions? Okay, I believe it's comprehensive. So let's test now. It's judgment day now. So let's test and see if we understood evaluation and review. So we need to check by this test whether you can describe the process and considerations for evaluating misstatements as per ISA 540. We also need to test that auditing opening balances and prior year narrative is well comprehended. And also we need to explain how to audit subsequent events in accordance with ISA 560 on what is ISA 560 on subsequent events, and also summarize going concern and its application in ISA 570. Okay, so are we ready? I have Julie on the call, but don't forget, please, 100% is a no-no. We understand that my modus operandi now. So 80%, 60% is fine. So you have to, it means you have to give me something. You must give me something. So Aisha, you and Rufi, you bullied me yesterday and you ran away. So today is my day. Yes. So and Julie came and compensated me yesterday. So Julie is always nice to me. But you and Rufi, you're always out for me. So let's see today now. Number 1, which of the following items might affect the going concern assumption? It even started with going concern. Wow. Roman numeral I, the use of short-term finance for non-current assets. Roman numeral 2, reliance on a single product. Roman numeral 3, lack of market competition. Roman numeral 4, a high gearing ratio. So which of the following items might affect the going concern assumption? A, 1, 2, 3. B, 1, 3, 4. C, 2, 3, 4. D, 1, 2, 4. We need to look at this question closely. Which of the following items might affect? It's even might, it's not even certain.
It's not
the
certain.
Going concern assumption. Okay. So 3, 3 for each option. Make your pick. You need to eliminate one out of them. I'm very sure some people will not score 100. I know some people must do giveaway.
With this, yeah.
Yes. And I'm happy with these questions. It's not like case study where people dealt with me yesterday. Only Julie and Rufi had pitied me. Okay, so which of the following items might affect going concern status? Use of short-term finance for non-current asset, reliance on a single product, lack of market competition, a high gearing ratio.
Oh.
Take your pick. Is Julie there? Yes, she's there. Julie,
it's
I'm
very
not fast.
confusing.
Yeah,
it's I shall even see how it's connected to going concern anyway. So
so even yes, I agree with what Judy said. I'll still go with C. That's good. I think it will be fine. Yeah.
Okay, 2, 3, and 4. Okay, you're going with C. All right. C. I'm happy that at least this is ICAN standard now. Nobody's answering very fast. Now we are talking.
It affects.
Yes, might affect the going concern assumption. Make your pick, Julie. You need to make your pick. A has picked, so we are waiting for you, Jay, so that we can go to the next pepperish ones where you definitely do give away.
This one is not pepperish.
you see some pepperish ones. This one is not pepperish very well. All right.
Okay.
I'm waiting for you. A has picked C. Maybe you want to go with her.
I think I'll go with her. I'll go with her. Wait, I'm coming. Hang on, just hang on, just a minute.
Sisters,
I know for it.
sisters. Sisters supporting sisters. Okay, let's see. Women supporting women.
I'll go for D.
Okay, 1, 2, and 4. 1, 2, and 4. Okay, let's see. J is going for D. A is going for C. All right. We took time in that question. Number 2. Another one again. I like this. Which of the following periods are considered in the auditing standard ISA 560, which is subsequent events, up to the date of the audit report, after the date of the audit report, but before the financial statements are issued, after the financial statements have been issued? I like this question. Which of the following periods are considered in the auditing standard ISA 560, subsequent events? A, period 1 only. B, period 1 and 2 only. They didn't mix these options very well. This one may be easy to get. C, period 2 only. And D, period 1, 2, 3. Okay. I'm just smiling because I know it must be giving giveaway today. That some people like it or not. Yes. Which of the following periods are considered in the auditing standard 560, subsequent events? And I like some questions. If you fail them, you'll never forget them. You always have something to write when you see it in the exams. It's kind of tough questions. So what's your peak? ACAs. You have to be fast. No time. Which of the following periods are considered in the auditing standard ISA 560 subsequent events? Okay, C. 2 only. Okay, she's going for C again. All right, J, what's your pick? J, dear.
No. I'll change it to A.
Okay, period 1.
Audit report, yeah.
Okay, I considered in there. Okay, she's changing from C to A. J is just quiet. She's thinking deeply. Yes, he's thinking deeply. So this is judgment day, exam day. So make your pick. Time is running out on us.
Yeah, putting pressure on us so that we can fail. We are putting this pressure.
I don't want you to fail. I just don't want you to score 100%. Understand my objective. My objective is for you to pass, but not 100%. At least I'm fair, you know. So score 60, 80 is fine, 50, no problem, but don't score 100%. And that's my objective. So what's your pick? Or A, do you want to change your mind? You are okay with A or C? Final answer.
I'll take D again.
Okay, J is going for D again. All the options. 1, 2, 3. So A, final answer A. Are you okay?
Yep, final answer.
Okay, so let's go. Oh, this one, I know the answer this one first. There's no doubt. Roman numeral 1, 2, 3, 4. Okay, which of the following statements is incorrect? Wow. The audit of opening balances and prior period comparatives should be straightforward, except in the audit of a new audit client. Wow. B, when other information is published with the financial statements, the auditor should check that this information is not inconsistent with information in the financial statements. C, when other information published with the financial statement contains a when other information published with the financial statement contains a significant misstatement of facts that do not relate to information in the financial statements, the auditor is not required to do anything. D, before the audit report is issued, the auditor must look actively for significant subsequent events. Which of the following statements is not correct? So take note, incorrect is not correct. Which of the following statement is not correct? I'll go again. The audit of opening balances and prior period comparatives should be straightforward, except in the audit of a new audit client. B, when other information is published with the financial statements, the auditor should check that this information is not inconsistent with information in the financial statements. C, when other information published with the financial statement contains, a significant misstatement of fact that does not relate to information in the financial statement, the auditor is not required to do anything. D, before the audit report is issued, the auditors must look actively for significant subsequent events. What's your pick? Which statement is not correct out of all of them? Everybody is quiet. Wow. This exam is hot. Evaluation and review is hot. I hope we are there. Everyone is quiet. Hey, Jay, what's going on? A is even muted.
Jay is muted.
She has unmuted now. A is thinking deeply. J, too deep thinking. No, the good thing is I pray you guys pass, but I'm just very certain that there must be giveaway. That's the joy. So guys, you make your pick. I like the questions. Make your pick, time is going. Which of the following statements is incorrect? The audit of opening balances and prior comparatives should be straightforward, except in the audit of a new client, audit client. When other information is published to the financial statements, the auditor should check. Okay, J is going with A. A, what are you going with?
Wait, not yet.
She has to change it. Okay, we're waiting time.
Incorrect.
A is going for C now. J, are you changing to A or you are staying with A?
C. Let me just think again.
Okay, you want to change from A to C too. You want to join A to pick C. What's your pick? Time is going out. We still have one topic to look at.
B. I think B is it. B.
Okay, B is incorrect. All right, we'll see. J is going for B. We'll see. They featured that one that I like. All right, number 4. If after the financial statements
are already.
Yes, okay, number 4.
Yeah.
If after the financial statements have been issued, an auditor became aware of a fact that, had it been known earlier, might have affected the audit report, which of the following measures should the auditor take? A, management should be asked to issue amended financial statements. B, the amendments should be audited. 3, the auditor should extend the review of subsequent events up to date of the revised audit report. 4, the auditor should issue a new unmodified audit report. A, 1 only. B, 1 and 2. C, 1, 2, 3. D, 1, 2, 3, 4. If after these financial statements have been issued, an auditor became aware of the fact that, had it been known earlier, might have affected the audit report, which of the following measures should the auditor take? What's your pick? This test is hot. The people are quiet. Remember one of my lecturer in school, he would say, everybody keep quiet. When you ask a question, you can answer, you say, yes, everybody keep quiet.
It's not often like taking 2 and 3. The management should ask to ensure immediate financial. I'll go with 1 and 2. That's B. But yeah, I'll just go. I see.
J is going with B. Oh, sorry, A is going with B, not J. J is still quiet, very quiet.
I don't know what to say for this one.
I like this question.
Sorry, can I change it to C?
Of course.
1, 2, 3.
Thank you. 1, 2, 3. Okay. J is going for C. Let me appreciate you guys in advance for the giveaway you are reluctantly giving me. I like it.
I think this giveaway is going to be massive because this one is tough.
Especially for our please for you're compensating me for case study yesterday. Case study bully. So I'm smiling now. But Jay, I know you won't do too much because yesterday you gave me one. So I'm rooting for you. But for A and R, no, I'm not rooting for them. You bullied me yesterday, so Jay, try and get this one. Go, Jay. Go, Jay. Go, Jay. I'm rooting for you.
You're having a good time.
Yeah.
The thing is, the options are long too.
Okay, you pick number 1 only.
Yeah.
A. Okay, Jay is going for A. All right. We've taken so much time in this test. So finally, this one will be easy. There's no.
I pick one now. Wait, so let me. Sorry, can you go back a bit? Sorry, just one. Just go back a bit.
Number 4. Okay,
I'll take 1 and 2. Wait. Have been. If an error have been shown, another should be. One is okay. A is fine.
Okay. Number 5, who is responsible for making the going concern assessment? Management of the client company only. Audit committee, the auditor only. Management of the clients and the auditor. Okay. Who is responsible for making the going concern assessment? Management of the client company only. Audit committee, the auditor only. Management of the clients and the auditor. Quite tricky. Okay, J is fast. Are you sure it's C? Final answer.
Yes.
Okay. A, make your pick. A is still thinking about it.
I will follow the crowd. C. I'll follow the crowd.
Okay. We're going for women supporting women. Okay. Let's see. So let's go now to the day I'm going to smile. Number 1. Jay got it. Jay got it to number 1. Jay got it. Why? Jay has gotten it. Lack of market competition should assist the company, not endanger its going concern status. Wow. Jay got it. D.
Can I remember the question?
What's the question again?
Let's go back to read it.
I can't.
The following items might affect the going concern assumptions. So the answer is D, 1, 3, and 4. So lack of market competition will not affect it. Use of short-term finance for non-current asset, of course, will affect it. Reliance on a single product, of course, big one. Higher gearing ratio, big one, where you have more debt to equity. So lack of market competition is not. So you chose C. And I think you chose D first, you now changed it. You chose C. You said 2, 3, and 4. So you ignore the use of short-term finance for non-current assets. So for fixed assets, you shouldn't be using short-term finance. You kill the company. So take note of that in going concern assumptions. All right. Jay, congratulations. Number 2. Jay got it again. Wow.
Hey, come and see me. Hey, what's the question? Let me see.
Which of the following periods are considered in the auditing standard ISA 560 subsequent events? So Jay said D, period 1, 2, and 3. Exactly. So up to the date of the audit report, of course, you must consider that. After the date of the audit report, you must consider subsequent event. Also, after the financial statements have been issued, you must also consider subsequent events. So period 1, 2, and 3 is correct. So A picked A. She said period 1 only, no? You have to consider 3 of them. Subsequent events, whether you've issued financial report, financial statement date, or after financial statement, any significant matter that comes, you must consider them in the financial statement, especially material ones. Okay, good one, Jay. You really used your instincts. And number 3, okay, A got this one and Jay failed it.
Okay.
Number 3, C. So number 3 is, which of the following statements is incorrect? And the answer is, when information published with financial statements consists a significant misstatement of fact that does not relate to the information in the financial statements, the auditor is not required to do anything. Exactly. So J picked.
Let me see. What did they say?
J picked B. When other information is published to the financial statements, the auditor should check that this information is not consistent with the information in the financial statements. So you picked A first and picked B. So B is incorrect because financial and non-financial information must be consistent. Exactly. So A, good one, A. All right. So let's look at.
But let me go back to see. Let me see the answer. Oh, let me go back.
Okay,
when the other that is incorrect. When the other information published is not a fact that.
Yeah, so the answer is C.
Okay, it's all right.
When
yes.
Information published. Yes, the answer is C. Okay, so let's go number 4. C. A got it again, and J dashed me giveaway. So C, the answer is the auditor should issue a new audit report to go with amended financial statements, but the report should be modified to include the emphasis of matter paragraphs. Yes, we said that.
Did you discuss matter paragraph today?
No, we spoke about matter paragraph, but we'll talk about it in another chapter. We didn't discuss it elaborately.
What matter paragraph?
So we'll be speaking to that in reporting, I think chapter 14. Okay, so if the financial statements are published, the answer is C, 1, 2, and 3, and A picked that. Management should ask to issue an amendment of service. So the option that is incorrect is the auditor should issue a new unmodified. So the auditor should issue a new modified audit report, and we spoke to that in the lecture. So that unmodified was what I guess confused you. So in the matter of events after report dates, auditors should ask to issue the amended financials, and the amendment should be audited, of course, and the auditor should extend the review of subsequent events up to the date of the revised audit opinion. So if he needs to modify the audit opinion or audit report, he should do that, not unmodified. So that's where you got it mixed up. So the answer is C, and A got it. So 2 giveaways, both of you. Well, you are doing well. Mr. Macaroni, you say you are doing well. And number 5, oh, you guys both did give away. You guys both did give away for me. You guys are so
picking A.
Number 1,
the clients only.
and the answer is, who is responsible for making the going concern assessment? So it's management of the clients only. So the auditor cannot do it only. The management of the client and the auditor are not doing it. So it's not the auditor that is running the company now, it's management. And they are to assess the company.
Assessment. Is it not the auditor that goes to assess the going concern status?
Oh, he's reviewing based on ISA 570. It's management that will make the assessment and give him in writing that this company will be a going concern in the foreseeable future. It's not the auditor that will do the assessment. He will just
making the going concern assessment.
Assessment, yes. So responsibility is with management, not with the auditor. So take note of that. So let's look at the answer again, number 5. Yes. Management is responsible for making the going concern assessment. The auditor is then required to assess the appropriateness of management service. His one is just a review now. He's not the one running the company, so he should assess the appropriateness of management's assessment.